Have you ever wondered how the Bank of Canada's interest rate decisions impact the multifamily real estate market? Well, today's episode dives right into that question. Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy McKay. Let's get right to it. In a recent move, the Bank of Canada has decided to hold its overnight lending rate steady at 2.75%. This decision follows a year of rate cuts aimed at energizing the country's property market. However, many in the real estate industry, particularly those involved in multifamily investments, were hoping for further reductions to spur growth. According to Gary Marr from CoStar News, the central bank's decision has left some property professionals unsatisfied. Christopher Wine, the chief operating officer of Burlington, Ontario-based multifamily company Equiton, expressed disappointment, stating that another quarter-point reduction could have built consumer confidence. He believes that Canadian consumer confidence is at an all-time low, or a 10-year low, which is affecting pre-construction purchases and freezing the housing market. It's important to note that the Bank of Canada has cut its overnight lending rate by 225 basis points over the past year, a move matched only by the Bank of New Zealand among developed countries. Despite this, the real estate market, especially in major areas like Toronto, continues to face challenges with declining home sales and prices. The Toronto Regional Real Estate Board reported a 4% decrease in average sales prices in May, compared to the previous year. The decision not to cut rates further comes amid global trade tensions, particularly U.S. President Donald Trump's threat to increase tariffs on Canadian steel and aluminum. This uncertainty has made the Bank of Canada cautious as they monitor the effects of these tariffs on the Canadian economy. Despite this, money markets and economists are still expecting at least 2 more rate cuts by the end of the year, according to Marcus and Millichap. For commercial real estate investors, further rate cuts could lower borrowing costs, especially for those with variable rate mortgages. However, the cost of borrowing for property sales is more influenced by longer-term money, such as the 5- and 10-year bond yields, which are expected to rise due to inflationary pressures from tariffs. In summary, while the Bank of Canada is holding rates steady for now, the possibility of future cuts remains. This could bring some relief to the multifamily real estate market, but the ongoing trade uncertainties and inflation concerns continue to pose challenges. We'll keep a close eye on how these developments unfold and what they mean for investors in the multifamily sector. Cameron Stevens, Mortgage Capital Limited, has recently launched the Western Canada High Yield Mortgage Fund, which is set to deploy an initial equity commitment of $70 million. This fund is designed to capitalize on a robust pipeline of commercial real estate deals, with a focus on secured lending throughout Western Canada, particularly in Alberta and British Columbia. The fund structure includes $35 million in commitments from Western Canadian real estate family offices, along with a $35 million allocation from Cameron Stevens Bay Street High Yield Fund. This initiative is part of the Toronto-based firm's broader expansion strategy in Western Canada, where it has grown to oversee over $550 million in assets over the past 4 years. According to Steve Cameron, President and Chief Operating Officer, the Western Canada High Yield Mortgage Fund is built upon the proven success of their Bay Street High Yield Fund, which has delivered net annualized returns of 11.4% since its inception in 2004. This new fund aims to provide capital more efficiently and with greater flexibility, leveraging local expertise from a newly formed Western Canada Investment Committee. The fund is modeled after the Bay Street High Yield Fund, offering investors access to diverse mortgage investment opportunities. Phil Housley, Cameron Stevens' chief of staff, highlighted that the fund will primarily target income-producing properties and land with development potential in Alberta and British Columbia. There is strong borrower demand for non-bank financing, particularly for light industrial, multifamily rental, and well-located retail properties. In its initial phase, the fund will engage in construction loans, and is set to participate in syndicated first mortgages, taking a 10 to 15% subordinated position in deals ranging from $10 million to $50 million. This strategy enables Cameron Stevens to potentially fund $600 to $700 million in originated loans in Western Canada, focusing on high-quality sponsors and strategically located assets. Brad Wise, Senior Vice President and Managing Director for Western Canada, emphasized the importance of collaborating with respected and experienced Western Canadian real estate families. Their involvement not only provides capital, but also brings invaluable regional insights to the firm's operations in the area. The firm plans to scale the fund further with additional equity infusions, drawing from the success of the Bay Street High Yield Fund, which started with $25 million and grew to over $350 million. Phil Housley expressed confidence in the long-term potential of markets such as Calgary, Edmonton, Vancouver, and the Fraser Valley. Cameron Stevens aims to originate $1 billion in commercial mortgage loans in the region within the next 2 to 3 years, reinforcing the critical role of private credit in real estate development and refinancing. Next up, let's shift our focus to Bosa Properties, a Vancouver-based real estate investment company, which has made strategic acquisitions in Burnaby, British Columbia. According to Evan Duggan from RENX, Bosa Properties has purchased 2 sites along Kingsway in Burnaby's Royal Oak neighborhood. This includes the Best Western Plus Burnaby Hotel, located at 5411 Kingsway, and an adjacent parcel at 5367 Kingsway. The acquisition, facilitated by NAI Commercial, is part of Bosa's ongoing strategy to expand its footprint in the Burnaby area. Mark Rico, the Executive Vice President of Commercial at Bosa Properties, mentioned that the firm has invested $6 million to renovate the 137-room hotel. The upgrades include enhancements to most washrooms, new flooring, furniture, and soft goods. Rico highlighted that while there is potential for redeveloping the site into a high-density mixed-use project, the immediate focus is to capitalize on the hotel's potential. The renovation aims to reposition former meeting spaces into a new breakfast and lounge area, catering to the busy summer season and the upcoming FIFA World Cup in 2026. The current hotel operation provides an accessible price point with surface parking, appealing to visitors, families, and sports teams. Rico emphasized the importance of the tournament market in Burnaby, which remains a significant element both in winter and summer. Although the purchase price of the properties was not disclosed, BC Assessment valued the Kingsway sites at over $33 million. This acquisition adds to Bosa Properties' extensive Burnaby portfolio, including ongoing projects like the Soul House 6035 and the Element by Westin Hotel. According to a report by Destination Vancouver and the BC Hotel Association, Vancouver needs 10,000 additional hotel rooms by 2050 to meet demand. While Bosa's acquisition does not immediately add new rooms, future redevelopment under Burnaby's Royal Oak Community Plan could potentially include additional hotel space. Rico mentioned that the views from the site are attractive and that there is opportunity for higher density projects in the Royal Oak area. This could extend the development power of the Metrotown node eastward, with a mix of condominium and rental housing, along with strong mixed-use amenities. Despite current market uncertainties slowing down decision-making across asset classes, transactions and leases continue. Bosa Properties is also developing approximately 1,500 purpose-built rental units and seeking new industrial development opportunities. Rico expressed optimism about Vancouver's long-term prospects as a desirable investment destination. Stephen Chen, a broker with NAI Commercial, noted that the strong hotel market in Vancouver was a driving factor in the acquisition. The potential for redevelopment was initially appealing, but operating the hotel has since become a key focus due to high demand and limited supply in the region. As we wrap up this episode, it's clear that Bosa Properties' strategic acquisitions and renovations reflect the dynamic nature of the real estate market in Western Canada. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy McKay. See you on the next one.